One of the things we've learned over our long history here and elsewhere is that investing is one of those things that everybody makes it too complicated. We like to make it simpler in some ways, and simple for us means do things that you have a high probability of success, avoid doing things which you really have a low probability of success. And unfortunately, conventional wisdom for investing and a lot of the information we're all bombarded with is really short-term in nature. It's kind of lottery tickets where people are guessing what's going to happen next. You don't do successful investing by guessing, and that's a really tricky concept. And it's just interesting. I'm going to try to walk you through the philosophy. And for some of you, the parts that won't resonate will be maybe because they're wrong, you disagree with them, or maybe because they're different. And different is, as Tom said, something we're very focused on because we think there's opportunity when you have a different view of things. Again, if you go back to us for a second, and for me specifically, there's absolutely nothing extraordinary about us at all. We work really hard, but otherwise we're very mediocre, and we do the best we can every day and try to do the best for our clients. So you got to have an investment strategy that works with your mediocrity, and so that's the whole point. By the way, for the record, the foundation is not mediocre, the committee is not mediocre, I'm just talking about me. I don't want anyone to get confused by that point. So where we haven't been mediocre, and the foundation, I should say, has not been mediocre, let me just explain the governance model. The foundation has a finance committee which reports to the board, which makes the investment decisions here. So when you see investment results, it's not Colonial's results or Mike Miller's results, they're the foundation's results. And they're the foundation's results, which were created in a partnership of like-minded people trying to achieve the same goal, which is investment excellence. So mediocrity can deliver investment excellence, I should say. And the point is that is what we're trying to do. So again, and I will say one of the things I tell the committee, which makes me quite popular with them, is all the really good things that have been done are their responsibility, and all the stupid stuff is my fault. And that's been a very effective part. That's why I've lasted 25 years. So this is a snapshot of investment returns. We did it through May because I had to get these slides to Tom. And so we didn't have June. June was a good month, by the way, but we missed it. It's not in these numbers. But this is through May. There's a lot of bars on this. Let me explain what you're looking at. The blue bars are the Community Foundation's returns net of investment management fees. The gray bar is CPI plus spending. That's our long-term objective, which is we want to preserve the purchasing power of these assets for many, many generations. The red bar is a 60% global stock, 40% bond mix. You could buy that very cheaply with 2 index funds. And the green bars, last but not least, are a custom market benchmark. A little later, I'm going to show you how we've allocated this money. The custom market benchmark just takes an index fund and assigns it to all the different pieces. So it's a kind of a complicated benchmark. So we put it here because that's what the committee looks at a lot, and we look at a lot, and we use that benchmark to decide whether or not we're picking good managers or not. That's the point of having a custom market benchmark. The 60-40 is there because what if we just made it simpler? How would we do? We just 60% stocks, 40% bonds. So that's a critical part of this. So each one of these has a reason to be. For 3 years, you can see we've actually had a very nice record where the foundation's compounded at about 8% per year net of fees, and all the benchmarks are less. The closest one is the custom market benchmark in terms of its returns, but it's still underneath that, and that's obviously a good outcome. All the way back out to where Colonial started here, and the foundation's actually compounded about 7.5% per year, which is also above all the benchmarks here, as you can see. I'm going to show you a little bit later about how we think about risk, because there is a very important part about risk, but this is about returns. And I will tell you, just to get to one of the punchlines, there's no world where we sacrifice lots of return to keep risk way down, but you cannot ignore risk in investing. If you do that so at your own peril and our own peril, so we don't do that. So all in all, this has been a very good outcome for the foundation. And I will point out one last thing. The November 1st, 1994 date, you can see the blue bar to the gray bar. One of the problems with the way I'm presenting this, which is per year numbers, is it sort of diminishes the impact of almost 25 years of doing better. That spread you see actually translates to about 15%. So if you take the $100 million on average that's been in this portfolio over time, 15% is $15 million of purchasing power enhancement that is benefited and will continue to benefit this community and all the work you do as philanthropists in this community. So it's a really important outcome. So back to mediocre. So let me tell you what we didn't do. We didn't make any brilliant forecasts about the global financial crisis. We have not predicted, by the way, how the S&P would dominate other indexes over time. We didn't know interest rates were going to fall. I'm going on a whole laundry list of things we didn't know. And the only brilliant insight we did have is that we were never going to know. So we didn't try. And that's how you get to this philosophy. Point one, think long term. Everything we talk about with the committee and the committee thinks about is based on long-term analysis. When the committee meets 4 times a year, everyone in the room would love to know what the S&P is going to do for the rest of the year, or all the things that you're bombarded with. Never comes up, only because they know if they ask me, I'm going to say, oh, I don't know. And so we don't know what will happen, and we're very comfortable with not knowing. So you have to have a basis for what you do, and that's long-term thinking. Second point, which is related to not knowing, we don't change the philosophy because we think something's going to happen in the world. Now we do, though, react to things. So let me give you an example. Back in 2008, when there was obviously, as you all remember, called so well, a very significant crisis. And at the time, a lot of endowments, foundations, public plans, et cetera, were having big liquidity problems. And they needed to get rid of private equity funds they held because they needed the cash. So the foundation at that time invested in a fund that bought these things up at 40 and 50 cents on the dollar and provided liquidity to other investors who needed it, because we didn't. We had plenty of liquidity, and has made a fortune on that fund. So that's the concept that we're not asleep. We're sitting around, we're looking, where are there opportunities, where are there places where we can get paid to take risk or provide liquidity. And so that's how so it's a reactionary, not a proactive process. And last but not least, again, speaking just for myself, if you're a risk taker, and I'll come back to this a few times, one of the things you have to do, though, is there is a free lunch out there, which is diversification works. And my phrase, I'm sorry, I hope I get a laugh or two, is the ignorant man diversifies. Because actually, if we knew what would do best, we'd put all the money there. But we don't. So when we get to the mix in a minute, you'll see it's very diversified. And here it is. These are the strategic policy weights. And so this is a portfolio very much geared to the long term. It's 57% in stocks in the public markets, which, by the way, is a combination of index funds and active management. We believe in both. We like fees to be lower, but we also think we can get paid if we find really special investors, and they do exist, believe it or not, in the world. We only have 21% in bonds, and you can see 4% of that is in high yield bonds, which are kind of more speculative bonds. So we're really only 17% in bonds, and that's, again, reactive. We're not predicting interest rates are going to rise by any means, but we know that we're not going to make a lot of money owning bonds, and they're going to hurt our chances of earning that 7 to 8% return we need, because you're only getting a 2% yield on government bonds today. So we don't own as much in bonds as we'd like, and when rates rise, hopefully someday they will, we'll probably own more bonds, all else being equal. And then we do have some alternative investments at the bottom, which are more controversial, obviously, for most people, but have actually done extremely well here for the portfolio, and they've created a better risk balance in this portfolio, which I'll show you the implications of that in a moment. A couple quick things. We have small bands around each of these numbers. The portfolio is not allowed to drift far away from these numbers, and the reason is this is the finance committees and the board's idea and concept of how we want these capital invested. So there's no reason to be different than it, because if we didn't like these numbers, the finance committee can change them. So we don't say, oh, we think that the US stock market can do really well this year. Let's not hold 22% large cap, let's own 30%. We don't make tactical decisions because we don't understand why we would know that. And so that's a very important part of the equation for us too. So we stay very close to these numbers. We use cash flow to rebalance to these numbers. And then the committee wants to change it, they change it. They look at it about once every year to two. Again, because we don't have short-term insights, we don't need to look at it every meeting, and we change it when we need to change it. Any questions? I'm actually okay taking questions along the way. If people have questions about any of this so far?
I have a question.
Yeah.
How often do you rebalance?
We have a policy with these bands, and if you left it alone, so it's not a time policy, it's a threshold policy. And the reason and I'll get to what that means in a second, the reason we don't just do it all the time is because it does implicitly cost money to buy and sell securities. We're not paying commissions to brokers we are, well, actually we are. We're not, we don't have sales fees or redemption fees and things like that. But again, to your question, we set bands around 3 or 4% around these asset classes. And if they get violated, we automatically rebalance and don't do it until that time. Now, if you ran a simulation, I'll tell you why we need to run a simulation. I can't tell you actual history in a second. If you ran a simulation, that would lead you to rebalance every 18 months to 2 years historically, is kind of what the numbers would imply from normal market volatility. However, because, frankly, this community is, the growth that was discussed earlier has been immense. So we frequently have new cash to invest in the portfolio that comes from this community, and it essentially is used to rebalance along the way. So if we got cash in and large cap stocks were 21% and other things were or above, we would just put more of that money in large cap stocks and bring ourselves back to the target. So we've rebalanced very infrequently, to answer your question, Lynn, but 18 to 24 months is sort of what the policy implies. Okay. So I showed you earlier a chart in the beginning that we've outperformed index funds over time, even though we do use index funds. And I want to walk you through a little bit about kind of how we got there. So Colonial is not a huge firm, but we do have 24 people on our research team. And their job is to go out and find the world's best investors that are possible. Most of the time, and I'll get into some of the nuances of that, the best investors don't frequently call us. We have to go find them. We spend a lot of time begging for capacity, because actually, believe it or not, even though people love index funds, and they should, most of us, the fact is there are probably a couple of hundred amazing investors out there, and they're not amazing because I say so, they're amazing because they've generated amazing returns, but they're not running funds with TV ads. They're basically under the radar, and you have to go out and find them, and you have to convince them to actually, quote unquote, believe it or not, we have to beg them to take your money, which sounds odd, I know, because we are paying them fees, but they do exist. And that's part of the reason for the success you've seen. So point one, high bar. We're not interested in investment managers who outperform by a little. And the reason for that is twofold. One is, if you can only outperform by a little, then I fail to understand why I should take, it's not even a risk. I'm going to pay them more fees. I want an extraordinary outcome in exchange for that. I don't want an okay outcome. I want an extraordinary outcome, number one. So that's just simple logic, I think. And point two, we're going to mess up. And when we mess up, it's the sum of all these decisions that you saw in the beginning that is all that anybody cares about. And if you mess up, you need somebody to kind of bail you out, essentially. So the really good ones have to be good enough to make up for our mistakes. And I can assure you, despite the fact that we've outperformed all those periods, we've made more mistakes than I can count. In fact, that's all I think about is our mistakes. And I can catalog those for you later if you'd like. Second point, there's got to be an edge. What's somebody's edge? And by the way, if their edge is, oh, I know things other people don't know, well, that's not an edge. Or I think that gold's going to do this, or Brexit's going to look like this. That's not an edge. It needs to be an edge that usually has something to do with the depth of your analysis. That can be an edge, depending on the company. Two, it can be an edge because you're just more patient than other people. You're willing to wait around a long time for something to work. And most people don't invest that way. So you can have an edge that way too. But there's a variety of things, or it can be specialization. And I'll give you an example in a minute of a manager that really illustrates this. And last but not least, investing is about taking risk and getting paid to take that risk. There are risks you don't get paid to take. One is leverage. It can be especially excessive leverage. That's, by the way, if you have leverage on a portfolio, your time horizon automatically gets shorter by definition, because if things go down and you owe money, the amount that you owe doesn't go down and you get in trouble. So we don't do that here. Second thing, we believe it or not, excessive risk aversion, that's people who are afraid. We spend a ton of our time worrying about whether the people who manage money in this portfolio are fearful or, forgive me for the word, but a little more on the greedy side. We want very confident people who have ability to understand they're wrong sometimes, but we don't want people who are afraid of everything. And we actually had a meeting, just to illustrate, I will not say the name, of course, we had a meeting with a firm about 6 months ago, and when asked the question about performance, the portfolio manager practically started crying, which I thought was a little bit of a problem in terms of fear. We didn't, by the way, we had not invested with him. We were trying to see if he might be interesting. That was a quick meeting. And last but not least, destabilizing liquidity structure. For anyone who owns a mutual fund that has bank loans or high yield bonds in it, you should be nervous. So that's an unstable liquidity structure. Those markets aren't always liquid, and mutual funds offer daily liquidity by 2 p.m. That's a destabilizing liquidity structure. So we avoid all those risks. So again, we're looking for excellence. And the assumption, to be clear, is that most people will fail. So we are not trying to do a just system here. We are trying to pick exceptional investors. And you have to choose either to be too harsh or too lenient. We choose too harsh every day of the week. So my apologies to anyone who's an investment manager who's really awesome and we didn't get it. We're going to make that mistake. The ones who are the whole swath of mediocrity in this industry, that mistake we're not going to make because we're too tough. So this is a list of all the managers in the equity portfolio. So there's a lot, so forgive me, and I'm not going to walk you through all of these. But you'll see there's the name of the manager in the first column, the strategy they pursue for us, the date they were hired here. Performance relative to benchmark is, again, since the time they were hired here, what have their returns been per year? I'll get to what these basis points, mean in a second. What are their returns per year compared to their benchmark? So for example, Ashford at the top is a small cap US growth manager. They were hired here actually 13 years ago almost. They've outperformed their benchmark by 2.2% per year. So 100 basis points is 1%. So forgive me for the jargon on this page. And that's net of fees. So that's over almost 13 years, 2.2% per year outperformance. So that's a result that we actually consider very strong. We're happy with that. So you'll see there's managers like them that have been around a very long time. There's some much shorter ones as well. You see some minus signs. Not everybody's done well, by the way. And when they don't do well, and when they do well, we're always asking a simple question, which is, what are they going to do for us? How do we think they will perform? Ashford, by the way, I didn't do a chart, but I should have probably. If you went back 3 years ago, they'd been here at that point in time for 10 years, and they'd underperformed the benchmark net of fees by 1.5% per year over a decade. And this is where my gratitude to the Finance Committee is unending. We kept saying, we don't understand why the market hates their company so much. We don't understand why they are so stupid. I mean, they'd had some periods along the way that were fine, just to be clear. It wasn't constant misery. And the Finance Committee said, okay, we're going to trust you that these people know what they're doing. And lo and behold, they've outperformed by 30 percentage points over the last 3 years with the same portfolio that looked incredibly stupid 3 years ago. And so these things change, is my point. And being patient is not always the right answer, to be clear. Sometimes it's the wrong answer. But in this case, it was a good example of where patience really did pay off. As you look down this list, a couple other quick things to point out. One is when it says closed next to the manager's name, that's the begging. Those managers don't take capital. In many cases, they don't even take it from us anymore, the Colonial or the foundation. So if somebody, for example, came to Colonial and said, I have $250 million, I'd like to buy the Community Foundation's portfolio. Well, Colonial's a for-profit entity. We're happy to have a new client with $250 million. But if they said, I want the Community Foundation's portfolio, well, that's unfortunately not going to happen. Any name that says closed, they're closed. We cannot give them new clients. They don't want our money. And the theories there, again, is performance is better because they keep the amount of money they manage at reasonable levels. And it gets back to this 25 years one more time. The patient approach of brick by brick building a portfolio really does pay off in the end. Last but not least, I wanted to point out the idiosyncrasies. First Light Capital in the middle. They're a new manager here. They were hired only less than a year and a half ago. They've outperformed their index by 52 percentage points. So if the index is up, I don't know the exact numbers, the index is up 5%, they're up 55%, just to give you a sense of that. And that's because they're a concentrated manager that buys small healthcare names. They bought, just to give you an example, I was talking about time horizon before. There was a company in the diagnostic world around diabetes that had been near bankruptcy. They didn't own it then. They did a stock issuance at $2 a share back in early 19, late 18. Because this is a small fund, they were able to get a pretty big piece. They put 10% of their fund in this company because they knew it was a great business and it just needed a better balance sheet, essentially, and the new stock issuance would give them that better balance sheet. So that stock closed last year, and so it was $2 a share, closed last year at $38 a share. Again, this is where time horizon advantage, depth of knowledge, no fear, because buying a near bankrupt company, putting 10% of your money there is a gutsy move if you think about it, but not if you know a lot. And so that was part of that answer. Okay, questions? Yes, sir. Oh, I'm sorry.
Just give a benchmark for how much you like in active versus passive.
We don't have a benchmark, Mike, but I will say this. If we're going to use 20 stock micro-cap healthcare managers, you better have a healthy level of index exposure because, by the way, they either will do stupid things or look like they're doing stupid things, so it could be painful. So it's not a benchmark, but I'd say we tend to feel very comfortable having 70% in really well diversified active management and 30% passive, but that can range up and down depending on the opportunity set. So for example, one of our goals is if one of these managers disappears and we don't like them for whatever reason and they go, the default position is go to the index until we find something that is extraordinary. So that's why it can flex a little bit. And we will tilt to active management, particularly today in the US. But with that said, there's no formal benchmark. So the question was, what does the spread mean? So let's say, I don't remember the numbers off the top of my head, forgive me. But let's say the index was up 7% per year. They're up 9.2% per year net of fees since 2006.
On an annual basis.
On an annual basis. So it's a massive, the 10-year number where they were 1.5% below was a massive cost to our portfolio. The 2.2% a year, but which again includes that period. I want to be clear, there have been success. We didn't cut off the bad stuff, it's still there, is a massive benefit to this.
How did you perform during 2008 and 2009?
Good question. I don't think I have a slide. We did a slide earlier for a different group. 2008, so I'm going to do, I know these only one set of numbers, so I'm not going to give you a count of 2008. I think 2008 was, I want to say down 28%, but let me give you a different number because that number I know. From the top in 2007 to the bottom, since we do monthly numbers in February 2009, the portfolio is down 35.4%. The S&P was down about 50% or so. Global stocks down about 60 to give you an order of magnitude. What I would like to say, if I could take your question and take it a little different direction, we lost 35.4% from that November 07 to February of 09. We had recovered all the loss by the end of 2010. So only 19 months later, 2 other quick stats if you don't mind. The bottom to May of this year, the portfolio earned 156% cumulatively, which I still am stunned by given what the world was like that time, which is a lesson in and of itself. But also, Mike, to your question, if you took it at the peak, the 07 peak to now, the portfolio has actually gained 65%, again, net of fees, which is, by the way, over 12 years, hardly a wow, what an amazing return, but it's still pretty stunning when you think about having a 35% decline at the very beginning of it. So those are some of the stats. I love when I get questions I know the answers to. Go ahead. Yes.
ETFs, you don't use any. You don't use any ETFs.
We use index funds, which is frequently what people do with ETFs. The foundation doesn't have a need to trade daily in things, and nor does the foundation worry as much like an individual should about the tax implications of index mutual funds versus ETFs. ETFs are more tax advantageous, as you know. So no, we don't tend to use a lot of ETFs or any, but we do use index funds, just to be clear. I just didn't list them here. So let's talk about the big picture and what we're doing. So by the way, we are like super giddy with excitement these days, and for reasons you may not expect, but I'll get to that in a second. First thing, it's confusing out there. I don't think I need to tell anybody that. And by the way, confusion breeds fear, confusion breeds short-term thinking, confusion breeds what we love to say is mispricing, or my favorite word in the investment lexicon is asymmetry. So asymmetry happens, and I'll tell you what that means in a second. So asymmetry in English means that your downside is fairly limited and your upside is huge. And that's what asymmetry is about. And the greatest investments you'll ever find have asymmetry. That's what we're looking for. And you get asymmetry when people are thinking short term and not thinking at all about long term. And our whole theory is put together asymmetric investments. You know, some of them are going to be wrong. The asymmetry won't be real. Some of them will be right. And you put it together, you get a nice balance. And that's what we're trying to do. So we like all this confusion, frankly. Although I'm not saying we enjoy people suffering. I don't want to say that. Should you be defensive? Because most people have this instinctive reaction to the unknown, which is normal. When the answer for us is no. And let me be clear. Personally, if you have a shorter time horizon, then confusion and short-term problems are real problems for you, and they're real problems for everybody. For a long-term endowment investor, though, short-term is short-term. We know our time horizon is infinite, so we're able to be comfortable with uncertainty because we have a different time horizon. So 3 quick things. Our ability to predict what's going on in the world is no better today than it was a year ago, 5 years ago, 10 years ago, 20 years ago. We have no idea, and we like that. We feel very comfortable. That which is surprising to others is not surprising to us because we had no opinion to begin with. Second point, if you allocate to areas with a margin of safety, pay less for things, in other words, which people don't do in the investment world. They like to pay more for things. People like to pay more for things because they like things that are doing well. They like things that are popular, like things where the story is clean and neat. That's a problem, though. When you pay less for something, there's less expectations in those returns, in those prices. And when bad things happen, and they always do, the fact that you paid less is a wonderful gift. Those things don't do as badly. That's part of asymmetry. When you pay for perfection and the world's not perfect, you can get crushed, and we don't do that here. And the last but not least, though, we're not ignorant about what's going on in the world. Brexit's a real thing. It's going to have some real implications. How it exactly plays out, we don't know any better than anybody else. But the fact is that if it does play out in some of the ways that are bad for companies, companies are going to suffer. Real economies are going to suffer either way. And so the fact is that we want our investment managers to make decisions with those things in mind. And last but not least, we like challenging climates, like I said a minute ago. So the key things we're doing are the following. One is being prepared. That's the diversification I showed you earlier. All the different types of managers we use is a big part. You can't decide to become diversified. You can't decide to become in pursuit of investments that have asymmetry when you need to be there. You need to already be there before bad things happen. Second point, we need to make sure our managers are acting rationally. Some of you are probably in the investment business in this room, so I'll say this, I hope you know I'm joking. Investment managers are actually human beings too. And so therefore, they're subject to life events, they're subject to age, they're subject to the things that make us different as we change through our lives. So we're very focused on, are the people we've hired continue to do the same job with the same approach that they have historically? And we spend a lot of time visiting managers, and the managers in this portfolio are currently on, I think, 4 continents around the world, and we're going to probably have 5 soon. And so we spend a lot of time on airplanes looking people in the eye, making sure that we are buying or keeping the same thing we thought we bought. Do you have a question, Mike?
Yeah, I have a question. Are you increasing your cash position at the moment in anticipation of the downturn that is inevitable?
No. So the question is, are we increasing our cash position in anticipation of an inevitable downturn? The reason is, the answer is no, although I agree with your second statement. A downturn is inevitable. That's fair. Maybe you can tell me, I don't know when it will happen, but it will happen. I think we can both agree on that. So why?
2020.
Oh, let's see. He's a braver man than I. Okay, 2020. Well, you and I got to have a talk. 2000. What date? Do you have a month in mind? So why?
Not that specific.
So why don't we hold? You did it well already. Why don't we do that? Why don't we take a more defensive role? It's a great question, and it's several things. One is, I'm not brave enough to make a forecast, so that's two. So gutlessness. The second, though, is that we have a long horizon, as I said before, and so yes, we could buy something here. It could do this on us. But if it eventually gets to here 5 years later, 3 years later, 10 years later, that's a happy result from us. So we're not trying to we don't think we're smart enough to buy it down here and figure out when to do that.
You don't have to try to time it.
We don't have to try to time it. We're so diversified, by the way, across all those different things that we actually do get protection in different ways. And the last thing I would offer, which I'll show you a graph in a second to kind of illustrate this point. There's some things out there right now that are actually priced for pessimism that we cannot even begin to understand. And that's where we're finding our asymmetry. So we feel like we could buy something, a bad economic or market event could occur, it would drop, but the drop would be so brief that we wouldn't even notice it because it's just too cheap already. It's already priced with a huge margin of safety. So if we can do that, we don't feel the need to own cash at 2% yields, essentially. So that's the answer.
The cheapness that you refer to is because of the PE ratios for these specific stocks? Is that how you analyze it?
We think, well, cheapness, so the question is, what is cheapness? And cheapness is in the eye of the beholder, so be careful with this one. So price earnings ratios or PE ratios are one way people decide whether things are cheap or not. We actually don't like that idea because, first of all, the E can change on you pretty quickly. What we like to do is we are very focused on free cash flow yields. When a company is generating a lot of cash, and by the way, if you want to look at a sector, to give you a good example, like the financial sector, the banking sector today is generating gobs of cash. And so that, in our way of thinking, is a good way to think about cheapness, as are other long-term measures of valuation. But at the end of the day, here's to your point, investing cannot be reduced to here's a number that tells me the answer. It's not that simple. And that's the problem that most of us have as investors, is that we don't have anything but those simple numbers to guide us. The people that you saw on that other page, the ones who aren't crying, those people are paid to do the following. Look forward 3 years, 5 years, forecast to the best of your ability the cash generating abilities of these businesses, the businesses of themselves. What are their moats? What are the qualities of their management teams? All the things you think that matter to a company. And then discount that back and tell me if that's below or above the current stock price. That's actually what all investing should be about. The problem with it, of course, is everything I just said. Predicting for the next 5 years what's going to happen is not easy. And so that's part of the equation that we also have to factor in. So there's a lot of complicated stuff that comes together. But I will say this, there's a lot of cheap stuff out there right now. Yes.
Can you comment on your hedge fund strategy or strategies?
Yeah. So hedge funds, very controversial part of the portfolio, as I said. We have a very simple approach to hedge funds. First of all, we don't actually, I'm just going to sound insane, but so hear me through if you don't mind. We actually don't like the vast majority of the hedge fund community, to be clear. The fees bug us. Yes, I'm not sure believe it or not, may not be the top of the list, but maybe it should be. What really bothers about most hedge funds is that most of them aren't actually investors. They're traders. They buy and sell stuff for things that we don't believe in. Like they think it's going to go up, so they buy more. I'm going to put it in gold. There's all this stuff that happens in the hedge fund world which we don't understand because we don't understand why it should work. I'll get to what we do in a second. We also don't like hedge fund managers that own all kinds of illiquid, complicated stuff that nobody can understand because then, by the way, you don't even know what it's worth, which is a really, really bad system. We don't like people who own things that we don't get to see. So quantitative hedge funds who trade all the time, you don't know what they own most of the time. That is very, very bad for us. We need to know what people own all the time. So what do we like? We essentially like hedge fund managers that are almost exactly like all our other managers except for one little thing other than their fees. They short sell. So short selling, for those who don't think about these things all day, is where you try to profit from a stock price dropping. That's all it is. So you You buy, one of the most popular shorts in the country right now is Tesla, for example. So if you think Tesla's business is not sustainable with its current operating abilities and balance sheet, you could short it, and if the price drops, you make money. So that's the difference between our hedge fund managers and the rest of the managers. So we're using a small extension of active management with the hedge fund managers, and that's what we use. And the beauty of that is they're mostly equity oriented. They don't use a lot of leverage or any. Their pricing is very transparent. We know exactly what those portfolios are worth. They're just publicly traded securities. And last but not least, we know what they own. And that makes us very comfortable and very happy. So let's talk a little bit about what's going on in the world today. So for those of you in the investment world, I won't torture you with this, I promise, for long. For those of you in the investment world, you've heard the terms value and growth. Value is a term that refers to securities that are cheaper. Generally speaking, people are more pessimistic about them. Prices are low. Growths are more interesting companies, companies that are growing, they're exciting, they're doing cool things like Tesla, and the prices tend to be high. So this is a look at data that compares back to the 20s. Gene Fama and Ken French are two University of Chicago professors who, by the way, are value-oriented, just to be clear, who did a whole study about stock price performance. And they discovered something which is really important behaviorally, which is that actually you can tell me that company X is better than company Y, and that may be true, but investors have a way of overreacting. They make company X, they price it too optimistically, they're too pessimistic about company Y because it's not doing as well. People don't like to own stuff that's not working, right? So what they found is that over 10-year periods, the people who buy the pessimistically priced stuff do better than the people who buy the cool, good stuff. And so that's what this chart means. So all the blue refers to, these are rolling 10-year numbers. Every time it's blue, which is almost the whole chart, as you can see, the cheap stuff did better than the expensive stuff. This is, by the way, for those who are interested in index funds, like a DFA type place, which is, by the way, what Gene Fama started, this is the basic principle behind it. And by the way, it's totally right, if you ask us. It totally taps into a real thing. However, this little red section here, I'm sorry, I'm blocking the screen again. On the left, that's the TMT bubble in the late 90s where it wasn't true. So pets.com was very popular back then, to give you a silly example. Then you see this big giant red section over here. That's the last basically 15 or 6, almost 13, 14 years of market history. Remember, each point is 10 years, where the opposite has been true. So in the innovation culture we think we have today, which people think is different than in the past, which it's not, the fact is that these companies are getting bid up, and the banks, the energy companies, the cyclicals are all crap, basically, as far as investors are concerned. So that's part of where, to answer Mike's question before, this is where that opportunity lies. The pessimism and the negativity around things that have cyclicality, stuff that's in Europe, stuff that's in Japan, is really interesting to us. Again, we're not going to bet the farm on it because we can't. I don't want to walk in here in some future meeting and show you how we underperform by 10%. But this is something that we think about a lot, and it's a big factor behind what's going on. One more. Oh, yes, sir.
I noticed a few slides back you indicated that you had no money in commodities, whether it's agricultural or gold or silver or whatever. What you just said, is that still true?
Tough questions. You guys are good. So we do not own commodities. Well, I will say what we do own, though, to be clear. So I'm gonna really answer your question in a second, I promise. We own a lot of stocks that are commodity backed, just to be clear. So we get exposure to a very depressed commodity cycle in that way, just to be clear. The reason we don't own the straight commodities is because actually they're still commodities. So we like to own undervalued stuff which has really, really high long-term return potential. We don't think commodities have high long-term return potential. They're more of a hedge. But we do get the exposure to the theme. I'm with you on the theme, by the way, just so you know. So one more thing. So talked before about this balance, and I'm back to the big picture now. Philanthropy is about taking a resource that those of you in this room and others have provided to benefit this community and to have it grow. And so one of the arguments that can be made is, well, if the stock market is the best place to invest long term, which it is, why wouldn't you just put all the money in the stock market? Because you're going to get the best returns. No cash, Mike. And that's a pretty interesting question, right? Why wouldn't you do that? Makes sense. So we haven't done that. And so why? Because I can assure you it's not to put Mike Miller's kids through college or to make the money managers rich in this portfolio. We could put all in the index and be done. So what we did is we wanted to show you why. And let me give you the punchline before I get to the numbers. The punchline is it is best to get the highest returns, except for one little problem. If you're taking money out along the way, the volatility, the 2008s kill you. literally kill you if you're too aggressive. And that's the why. So let me show you the actual numbers. So what we did here is we went back 20 years to May of 1999, excuse me, and we said, let's take $1 million shows up at the foundation's doorstep as a wonderfully generous gift to this foundation. And it's invested one of three ways. In the blue bars, and I'll show you what these numbers are in a second, it's invested in the pool, the numbers I've been showing you this whole time. In the orange bars, it's invested in global stocks, that's MSCI ACWI. And in the gray bars, it's invested in the S&P 500. So those last two bars are the 100% stocks, or the answer issue. So the first thing now, what we do, a couple more things. Took the $1 million and invested in those three portfolios, and then we did two other things. One thing we didn't do, never added a nickel to this account. So the donor showed up, handed the $1 million off, and then didn't disappear, but didn't make any additional contributions. Then we took one more thing we did. We took out 5% a year of a 20-quarter average, as you would expect, for the community, for our philanthropy. The bars in the beginning, ending fund balance, that's what that fund was worth after withdrawals, after fees, after everything, at the end of May. And you can see, actually, it's worth much more having been in the foundation portfolio than the two stock portfolios, which, by the way, is interesting because I will tell you this.
Would you repeat that? I didn't quite
So the blue bar, which is a little bit over $1 million, is higher than the other two bars, is all I'm saying. So there's actually more money in the fund if it was invested in the foundation portfolio than it was in the S&P or ACWI. You might say, so what? Maybe the S&P and ACWI underperformed. Actually, the S&P and ACWI outperformed, the S&P did, over this period of time, by just a little, not by a ton. If it outperformed by more, it'd be different. But the fact is the S&P did better than the foundation, yet there's more money left in the fund if it was invested in the foundation portfolio. And on top of that, look at the middle bars. That's what came out. So we took out the 5% a year. So all we did in the middle is we just added it all up, how much came out. So not only is there more money left in the fund at the end of 20 years, more money was distributed to the community through philanthropy. The philanthropy was higher as well from those things. In the chart I'm not showing you is these massive declines that happen from year to year spending in the two stock portfolios, because the impact of those 50-60% declines that happened at certain times during this period was nefarious. And by the way, I don't tell anyone in this room, the idea of philanthropy dropping for 7 straight years from a fund is a nightmare for anybody who's the beneficiary of that philanthropy. So these two things are, and the last bar is just a made up thing. We just took the two columns and added them, so I wouldn't pay much attention to that. But this is the point, which is there's a balance between achieving returns you need, because we do want the blue bar to be higher. We also want to distribute more. Keeping the volatility under control is important. So that's why do you own hedge funds? If we can get a 7% return with 70% less volatility in the stock market, that's interesting to us for this reason. Why do you own microcap healthcare managers? Because their returns are very different than our Japanese activist, and so that gives us even more diversification. And these are the things that are really important. And leads to the following, which is this is our whole philosophy. So before I said think strategic, don't do market timing, diversify, right? Those were the 3 rules. Let me add a few more. Be consistent. Maintain consistent risk exposure. Sounds super easy. When Mike asked the question before about how much did you lose in 2008, and I was quick to tell him the answer, and then also we got it right back by 2010. Well, that was because we rebalanced in to the equity decline, which again today seems like a layup. It didn't feel so easy back then, I can assure you. We all were a little nervous. And the finance committee again gets credit for that. Second point, volatility and emotion. It makes people nervous. My wife has to keep reminding me not to be giddy when other people are unhappy. But the fact is that those are the things that actually help us as investors. So the more people get nervous, the happier we can be. And last but not least, $250 million lets us do a lot of cool stuff, if you ask me. We invest with a lot of different types of managers, very different strategies. And some of this niche stuff, if you have a smaller portfolio, you just can't do it. The minimums are too high. There's all kinds of problems with it. So let me just say one more thing on this subject. This is, if you want to sum up diversification for us. And Tom before talked about change and trying to be forward-thinking, trying to get better at what you do all the time. So we're happy with the historic results, but we could always be happier. And so that's why we push our advantages every place we can. I got to tell you, the foundation portfolio has never been stronger in this regard, and it's because of the finance committee. It's because of, frankly, Colonial is also doing a better job than we've done before in a lot of different ways. And these are the two things I want to just emphasize. First thing is when you step back, all investing is an exercise in risk-taking. You have to, even if you buy an index fund, you're taking a risk. And so the wisest thing you can do is to try to diversify your risk as much as possible. So we think about diversification by active class. We think about diversification index versus active. We think about diversification stocks and bonds and all these things in investment style. But we also think about diversification in some other ways. Age. Younger PMs, I think the youngest we have in this portfolio now in his early 30s. But younger portfolio managers have a different view than older ones. Yes, they have less experience, and we have to calibrate for that, but they also have different perspectives. They buy things that older PMs might not buy because they don't understand how important they are, and vice versa. Location, having managers in Asia and Europe and maybe someday in Africa as well. People see the world differently depending on where they sit in this world, and that gives us another form of risk-taking that's beneficial. And then gender and race of our portfolio managers and owners of our firms, big part of our strategy as well, because gender and race also gives you a different perspective on the world. And when you can find equally talented people across age, across location, and across gender and race, which exist, and we have found them, we think, you get a better outcome. And that is a critical part of pressing our advantage in every way possible. And this is all about higher returns, less risk, and getting that balance right. Here's the Colonial Consulting commercial. Boom, we'll take that off. Are there other questions that I can answer? And you got a lot of good ones in there.
Why is the 60-40 magic split? How do you get those numbers? Are there other numbers that people use?
The 60-40 benchmark, you mean?
Yeah.
We use 60-40 because, by the way, I've been around long enough that was always the answer. We're back in the 80s, 90s, hey, 60-40. But let me give you a more intelligent answer than that. So one, it's just inertia. Two, though, it is the 60-40 has about the same volatility as this portfolio. So when you go back to the up and down bouncing around statistically month to month, so when you go back to that chart I showed you earlier about how the portfolio had done and the volatility, how it affected it, the 60-40 is a good comparable because it's about the same level of bouncing around. So that's how we get to it, too. All right, good. Well, thank you. It's been a real honor to be here with you. I hope to see you again soon.